The World Cup just generated $40 billion in economic impact. And almost none of it is going to end up in the pocket of the person who paid $1,000 for a hotel room to watch it in person. Welcome to The Explainer. I am absolutely thrilled to have you here today because we are going to be decoding some massive economic headlines that have been completely dominating the news lately. You know the ones, these huge multi-billion-dollar figures that make it sound like the entire economy is booming and everyone is just getting richer. But today, we're putting those numbers under a microscope.
So, the 2026 World Cup just generated an estimated $40.9 billion in projected economic impact. That is a staggering number. But as I just mentioned, if you're a fan who paid for a ticket, a flight, or a hotel, you aren't seeing a dime of that wealth. In this explainer, I'll show you where that $40 billion actually goes after the confetti settles. We're going to look at who really profits from a World Cup, why that pattern isn't unique to soccer at all, and what it teaches you about spotting who captures value versus who just pays for the show, in sports, in business, and in your own money.
Here is our roadmap for today's journey. First, we'll unpack the World Cup illusion. Second, we'll examine the earnings paradox. Third, we'll look at the Fed's next move. And finally, we'll wrap up with protecting your wallet. Let's jump right in.
Section 1. The World Cup Illusion, Mega Events and Missing Money. This World Cup was projected to generate close to $41 billion in additional global GDP across 48 nations and over 100 matches spread across 16 host cities in 3 countries. That number gets repeated everywhere, in news segments, in tourism board press releases, in FIFA's own materials, and it sounds like the whole world just got richer together. But here's what doesn't get repeated as often. FIFA itself is the clearest financial winner of every single World Cup cycle, generating an average of about $4.3 billion from the tournament. It gets there because it controls the most valuable and scalable revenue streams. We're talking global broadcasting rights, sponsorship packages, licensing. Those are recurring, high-margin revenue lines that literally do not depend on how many hotel rooms get booked in any single city. Host cities, meanwhile, take on a very, very different kind of exposure. They front the hard public costs, things like heavy security, transportation infrastructure, expensive stadium preparation and upgrades, and those costs don't always get fully recovered, even when attendance numbers look incredibly impressive.
To really put this into perspective, let's break down the sheer imbalance here. Combined, the 4 U.S. host cities in the southern half of the country, Atlanta, Dallas/Fort Worth, Houston, and San Antonio, are projected at $3 to $4 billion in combined direct economic impact. Now zero in on Dallas/Fort Worth alone, which hosted 9 matches, including a massive semifinal. They are projected at $400 to $415 million in direct impact. When you compare that highly fragmented, highly localized, and speculative impact to FIFA's $4.3 billion, which is generated centrally and locked in via contracts, the gap in who captures the value becomes glaringly obvious. The cities are the ones taking on the physical and financial risk. The central organization takes the guaranteed, scalable profit. It's like a giant funnel where all the hard work happens at the bottom, but all the guaranteed cash flows straight to the top.
And you know, it isn't just the cities taking the hit. Fans absorb their own version of this imbalance. In some host cities this year, hotel rates spiked by nearly 1,000% as the tournament approached, meaning a room that might normally cost $100 a night was suddenly closer to $1,000. And this isn't some brand new pattern. Let's look back historically. Brazil's 2014 World Cup cost the country around $15 billion to host. And in the years afterwards, several of the stadiums built or renovated specifically for the tournament just sat underused. These massive white elephants hosting far fewer events than originally projected, all while the country dealt with heavy criticism over displaced communities near those construction sites. Even the 1994 U.S. World Cup, which successfully used existing stadiums and launched Major League Soccer, had its direct economic gains for host cities heavily overstated by initial projections.
So, you might be asking, where do these massive projections even come from? Well, the math itself is often fundamentally flawed right from the start. Academic researchers who study these mega events have flagged a recurring methodological issue behind those huge economic impact numbers you see in the headlines. As this quote from a Clemson University working paper so perfectly points out, many of these studies fail to compare the spending against what would have happened in that local economy anyway. They completely ignore the counterfactual, meaning the money that tourists or local residents would have spent on something else in that city regardless of the tournament. Oh, you went to a soccer game instead of going to the movies in a local restaurant? The study counts that as new money when it really isn't. They also frequently use these expenditure multipliers that drastically inflate the apparent ripple effect of every single dollar spent. It's an accounting trick designed to make the final headline number look far more impressive than the actual verifiable local benefit.
Section 2. The Earnings Paradox. Record profits, stagnant pay.
Now, why did we just spend all that time on the World Cup? Because the exact same dynamic is playing out on Wall Street right now. The size of an economic number tells you almost nothing about who it actually benefits. We are currently in the thick of the Q2 2026 earnings season, which kicked off in mid-July, and the headline numbers are, quite frankly, staggering. S&P 500 companies are projected to post 22.8% to 23.8% year-over-year earnings growth. Revenue growth is projected at 12.2%. That is the highest quarterly revenue growth for the index since Q2 of 2022. These numbers represent multiple consecutive quarters of growth above 20%, totally blowing past the 10-year average of just 10.3%. So here is the paradox every single average worker is feeling right now. If companies are posting some of the strongest profit growth in years, why on earth doesn't this economic boom show up in the average paycheck? Why are we stuck in this weird low-hire, low-fire reality with negative real wage growth? Where is all that money actually going?
Well, just like the World Cup's impact was concentrated at the top, the stock market's booming numbers are highly concentrated. Take a look at this breakdown. Ahead of the earnings season, the energy sector saw a massive upward revision to earnings estimates, jumping by 61.5%. The information technology sector is up 8.7%, and that is largely being driven by massive AI data center spending from giants like Meta and Alphabet. Meanwhile, sectors like healthcare are actually expected to contract, partly due to things like expiring Affordable Care Act subsidies reducing procedure volumes. So what does this tell us? It tells us that the booming economy isn't a rising tide lifting all boats, it's a massive tidal wave localized entirely in the tech and energy sectors. If you aren't an investor in those very specific slices of the pie, you aren't capturing the value.
Let's talk about what this really means for you and me on a day-to-day basis. Of the first 18 S&P 500 companies to report their Q2 results, an astonishing 88.9% beat their earnings per share estimates. But here's the catch. Companies aren't achieving these massive earnings beats by drastically expanding their workforce or handing out massive raises to their employees. Not at all. They're doing it through ruthless efficiency, through massive tech and AI investments, and by maintaining incredibly tight labor costs. The record corporate wealth being generated in Q2 2026 is being captured almost entirely by shareholders and corporate treasuries. It is not being passed down in our paychecks. You are experiencing the economy as a worker who is paying inflated prices, while the headlines are written from the perspective of a shareholder who is capturing the profits. It's the exact same dynamic as the World Cup hotel room, just applied to the entire U.S. labor market.
Section 3. The Fed's next move. The rate reality check.
The corporate world is adjusting to a very specific macroeconomic climate right now, and nothing, and I mean absolutely nothing, dictates that climate more than the Federal Reserve. On July 28th and 29th, the Federal Reserve will hold its next meeting. And this right here is the question every single person with a mortgage, an auto loan, credit card debt, or cash in a savings account is stressing over. Will the Fed finally cut interest rates this month and give consumers some relief?
The answer, according to the futures markets, is a resounding 0%. Yep, 0. As of early July 2026, the CME FedWatch tool shows a literal 0% probability of a rate cut at this upcoming meeting. In fact, the real debate going on right now isn't even between cutting or holding. The market is pricing in a nearly 75% chance that rates hold exactly where they are, and a 25% chance that the Fed actually hikes rates by a quarter point. I want you to really think about that. We are closer to borrowing costs going up than we are to them coming down.
So why are they being so stubborn? Why won't they just give us a break? Because the raw data shows the inflation dragon has not been slain. Check out these metrics from May 2026. The Consumer Price Index, the CPI, rose 4.2% year over year. The Fed's preferred gauge, the Core Personal Consumption Expenditures Index, or Core PCE, came in at 3.4%. The Federal Reserve's stated target rate is 2.0%. Guys, they are missing their target by a mile. Because inflation is remaining so persistently high, the new Fed chair, Kevin Warsh, who just ran his first meeting in June, has been forced to hold the line. At that June meeting, the Fed actually raised its median year-end 2026 rate forecast to 3.8%. Half of the Fed officials now project at least one more rate hike before the year is over.
Let's just trace how incredibly fast this narrative shifted. In late 2025, the Fed was cutting rates. They cut in September, October, and December, bringing the federal funds rate down to its current range of 3.5 to 3.75%. Going into early 2026, the market was exuberant. Wall Street was celebrating. Everyone expected the era of cheap debt to return. But then the inflation data stalled, the Fed paused, and now, by the summer of 2026, the reality has completely reversed into a strict higher-for-longer regime. The optimism evaporated because the underlying data didn't support it. Once again, the headline expectation completely failed to match the structural reality.
Section 4. Protecting your wallet. Follow the money.
The pattern here isn't really about soccer, is it? It's about how big, exciting numbers get used to hide a much more specific and much more useful question. Who actually captures the value, and who just pays for the experience of being close to it? FIFA structured a system over decades where it holds the scalable recurring revenue, the parts of the business that don't require it to build a single stadium or staff a single security checkpoint. The excitement, the merchandise, the hotel nights, the flights, the inflated ticket resale prices, that's what gets sold to everyone else, and it comes with real financial exposure attached. This is worth remembering the next time any huge aggregate number gets thrown at you. An economic impact figure, a company's headline revenue, and hyped investment opportunity, even a real estate development pitch in your own city. The size of the number tells you almost nothing by itself about who it actually benefits. It's designed to feel inclusive. The world got richer, when the underlying structure is often quite narrow. So, what do you actually do with all this newly decoded information? Here are the actionable steps you need to take right now to protect your wallet. First point, separate the headline number from your own reality. A $40 billion global impact figure has absolutely nothing to do with whether you personally got any value from what you spent watching. A 22% corporate earnings spike has nothing to do with whether your real wages are keeping up with inflation. Ignore the aggregates. Look strictly at your own balance sheet. Step 2. Leverage high-yield savings accounts. With the Fed signaling that they are holding rates steady or possibly even hiking them, the cash you have sitting in a standard bank account earning 0.01% is literally wasting away. High-yield savings accounts become much more attractive in this environment because their interest rates can actually adjust upward if the Fed decides to hike. It gives you the flexibility you need while earning a solid return on your cash. Step 3. Be very careful about locking your cash into long-term certificates of deposit, or CDs. A CD only truly pays off optimally if you lock in a high rate right before rates fall across the broader economy. But since we just learned the market expects rates to stay higher for longer, trapping your money in a CD might mean you miss out on even better yields a few months from now if rates go up. Keep your powder dry and stay flexible.
And this brings us to our final thought for the day. We've traced how billions of dollars flow through global sporting events straight into the hands of centralized organizations. We've seen how record corporate profits bypass the average worker entirely and flow straight to shareholders in concentrated sectors. And we've watched how macroeconomic expectations can completely shift under our feet while the headlines lag weeks or months behind. So my challenge to you is this. The next time a massive headline claims the economy is booming or the world is getting richer, don't just nod and accept it. Stop, take a breath, and ask yourself the most important question in finance. Who is structurally designed to capture the value here, and who is just paying for the show? Thank you so much for joining me in this explainer. Keep questioning the numbers, stay focused on your own financial reality, and I will see you next time.